All right, so welcome back to the yet another reading in corporate finance. This one is dividend and stock repurchases. Originally, this reading used to be simply called as dividend policy. We recognize that a company can dispense of its cash to its stockholders via dividends or as stock repurchases. So we call it now a payout policy or dividend and stock repurchases. All right, we're going to start out with certain theories of dividends, and we're going to start out with our friends Miller and Modigliani. Their first theory says dividend policy is irrelevant, doesn't matter. Why? Basic concept here is you can always make your own homemade dividend. So if you want more dividend, you sell some stock. If you want less dividend, you don't sell stock. If you want zero dividend, you don't sell any stock. So that's the idea behind homemade dividends, and therefore dividend policy from the perspective of a company's policy is irrelevant, doesn't add any value. Well, it assumes that the markets are perfect. You can sell a smallest fraction of a stock if you want to be. There is no tax consequences of such things. There is no transaction cost. There is no bankruptcy cost. So all of these are inherent assumptions for this to work, which we call as, again, the dividend irrelevance theory. So once again, within the dividend irrelevance theory, the concept of homemade dividends, which is investors can create their homemade dividends by selling whatever portion of stock they need to sell to generate their homemade dividend. The second theory is the dividend preference theory, also known as the bird in hand theory. The dividend preference theory says that the investors prefer the certainty of dividends over uncertainty of capital gains. So you think about return from an investment in stock. Return is part of dividend yield and capital gains yield. Capital gains yield comes from price appreciation. Dividend yield comes from actual dividends. So investors prefer dividends over capital gains. And if that is the case, they're going to value dividends more highly, or they're going to discount dividends at a lower required rate of return. So if dividends are discounted at a lower required rate of return, the value of the firm will be higher if they paid more in dividends as compared to capital gains. So the result is higher dividends. The company with high dividend payout will be worth more in the market. So again, these are theories. So this theory says that those companies that pay higher amounts in dividend are going to be valued higher or more valuable in the market. The third theory is the tax preference theory. The tax preference theory says that investors prefer less dividends as compared to more. Why? Because dividends are subject to taxation, and therefore they are tax disadvantaged. So as compared to dividends, capital gains are taxed at generally sometimes taxed at a lower rate. So dividends may be taxed at a higher rate as compared to capital gains, depend on the tax code globally. So every country is different. However, even if they are taxed at the same rate, if capital gains and dividends are both taxed at the same rate, even then, at least investors have an ability to postpone taxation on capital gains until they sell it. So you can do the timing of recognizing capital gains, which is not true for dividends. So based on this theory, based on the tax preference theory, we say that investors prefer less dividends. So we went through irrelevant, meaning we don't care. The second one was bird in hand theory, which we said high dividends. Now we are talking about tax preference, which says low dividends. Now, other dividend policy theories, we'll talk about two categories. One is the clientele effect. Clientele effect says investors are attracted to specific companies. Certain groups of investors are attracted to specific companies based on their dividend payout. Well, this clientele effect exists because of, first, tax consideration. We'll see that in a second in the next slide. The second one is requirements of institutional investors, and then finally individual investor preference. Let's talk about the bullet points 2 and 3 first before we move on to the tax consideration. The first thing that I want to talk about is requirement of institutional investors is that certain institutional investors have a preference for certain type of income. So some investors may prefer less in dividends, some prefer more, depending on their individual needs. So based on that, some institutional investors, for example, may not prefer, because of high taxation on dividend, may not prefer any dividend payment. So they are attracted to low dividend paying stocks. Okay, so that is again based on the preferences or requirements of institutional investors. And just as institutional investors have their own distinct set of preferences, individual investors also have their own distinct preferences. So some individual investors may prefer long-term growth, in which case they want less in dividend. On the other hand, certain other investors, such as retirees, may prefer high payout. So this is completely subjective based on their needs about what dividend policy they are attracted to. Let's talk about the tax considerations. Tax consideration simply means that investors are concerned about after-tax income, right? So we are not concerned about pre-tax income per se. We want to really maximize our after-tax income. So after-tax dividend income is what? Dividends times 1 minus the tax rate applicable to dividend. TD is the tax rate applicable to dividend. Similarly, the after-tax capital gains income is 1 minus the capital gains amount, it's a dollar amount of capital gains, times 1 minus the tax rate on capital gains. When say for example, the capital gains after-tax income exceeds the after-tax dividend income, investors would prefer what? Capital gains. Similarly, you could have other way around, where after-tax dividend income exceeds after-tax capital gains. In that case, investors would prefer dividend income. When they are equal, there will be a point of indifference. Okay? When they are equal, investors are indifferent between either receiving dividends or capital gains. And if I solve this equation, and we recognize capital gains is equal to change in price, and I solve this equation, keeping capital gains on the left-hand side, bringing or dividing both sides of this equation by this 1 minus the tax rate on capital gains, this is the equation I get. So my equation now tells you the point of indifference where investor doesn't care between capital gains and dividends. Investor doesn't care between the change in price when the stock goes ex-dividend and the dividend amount. All right? So that's your point of indifference. So that was your clientele effects. Now let's move on to the second category of other approaches, other theories. And now we are looking at agency issues. Okay? Agency issues, again, covered all over the curriculum, all over CFA land, not only at level 2 but also at levels 1 and 3. And this is again about conflict of interest. First, we're going to talk about conflict of interest over plain vanilla stockholders and managers. This is your standard plain vanilla agency theory. So there is a conflict of interest between managers and shareholders, and we say dividends reduce the free cash flow. And again, we want to talk about mitigates over-investment problem or empire building problem. Okay? So dividend payment mitigates the problem of over-investing. In other words, investing in negative NPV projects or empire building, increasing the size of the firm. So it takes away cash away from the hands of the managers. In other words, it leaves less opportunity for managers to invest in empire building. Now, what about agency conflict between stockholders and bondholders? And this is kind of a stretch to call it agency, but that's what the curriculum uses, so we'll stick with it. And we say that there is a conflict of interest between shareholders and bondholders. We say that dividends transfer wealth from bondholders to stockholders. Why? Well, when the dividends are paid from the company, that leaves less of a collateral for the bondholders. So think about it. If the firm pays out large amounts of dividend, the amount that is left behind, the asset base that is left behind in the company becomes smaller. In other words, the bondholders will have lower collateral. They will become more risky. When the bond becomes more risky, the yield on the bond will go up in the market and the price of the bond will go down. The price goes down in the market, that is the loss of value for the bondholder. That value is then transferred over to the shareholders. So dividend payment transfers wealth from bondholders to shareholders, and this is again after the risky bond is issued. After the bond is issued, and now if the shareholders issue large dividends, the bondholders are affected negatively. Obviously, the bondholders are aware of this situation, and accordingly, they put specific terms and conditions within the bond indenture called as the bond covenants. So bond covenants specify the circumstances in which, how much, as well as the circumstances in which dividends can be paid. So covenants provide protection to bond investors. All right, let's talk about the signaling content of dividends. So signaling means the transfer of information from insiders to the outsiders. We recognize that the insiders have better quality of information. There is asymmetry in information. Insiders have high quality information. Outsiders want that information. Outsiders are trying to figure out that information. And the way they try to do that is simply to look for signals, and those signals are actions taken by the insiders. Now, when the insiders increase the dividend, that is considered to be a positive signal. Why? The main premise here is dividends are considered to be sticky. So what is the stickiness of dividend? We will be using this theme over and over again in this topic review. So let's understand it. Dividends are considered to be sticky, meaning the market really wants a firm to stay on course as far as dividend payout is concerned. So if a firm is paying $1 per share of dividend, they should not cut it. When they cut it, there will be a very strong negative reaction in the market, and managers are fully aware of it. So managers are recognizing that if I initiate dividend, I have to keep up with it. I can't do it at one time. Similarly, if I increase dividend, I have to keep up with the increased level of payout. I can't reverse it. I can't come down. Okay? So dividends are considered to be sticky, and therefore, when managers increase the dividend, market says, hey, not only is this quarter good, but the managers are confident of being able to meet that high levels of dividend in the future as well. So that is a strong positive signal that you're sending to the market whenever you increase the dividend amount. When the market, when the insiders reduce dividends, decrease it, or even cut it, in that case there is a typically negative signal, pretty strong negative signal. Why? Because the market receives that information as, first, this was a bad quarter. The company had a lousy quarter or lousy year. But not only that, it's not expected to turn around anytime soon. Why? Because if it was expected to turn around soon, managers would have stayed on course. They would not have cut dividend. But when they decide to cut dividend, they are signaling to the market that things are bad and they're not expected to turn around anytime soon. Initiation is a mixed bag. When a firm initiates dividend payment, it is positive if the firm is mature. If the firm is mature and was hoarding cash, and they now finally start getting rid of that cash, now they finally start giving that cash back to the investors, that's a great positive signal. On the other hand, if a firm is very rapidly growing firm, if the firm has a high growth rate and they have been keeping that cash to sustain that high growth rate, all of a sudden starts dividend payment, then the market may receive that as a signal that the growth is going to moderate. Maybe the growth is not going to be too high in the future. So it depends on the signal that is sent, and depends on the circumstances of the company that initiates the dividend. But generally, a mature firm, a firm that hoards cash, for that firm, initiation is a positive signal. All right. What are the factors that affect dividend payout? So these are the factors that systematically influence the manager's decision about the payout policy they implement for the company. The first factor is the level or extent of investment opportunities. Okay, firms that have large amounts of investment opportunities, they have lots of positive NPV projects, it makes a lot of sense for them to retain a lot of their earnings, and therefore dividend payment may be low. The second factor is expected volatility of future earnings. If volatility is high, then the dividend payout is going to be low. Remember, dividends are sticky. So if the volatility in earnings is high, we are not confident of being able to make to meet that high levels of dividend in the future. We might as well stay a little conservative and keep our payout low. So that is the second factor, the volatility of future earnings. The third factor is financial flexibility. Once again, dividends are considered to be sticky. If managers are concerned about being able to meet that obligation in the future, they want to retain that flexibility, they'll keep that dividend payout low. financial flexibility can be also used in such a way that you use repurchases in lieu of dividend. Okay, so we use repurchases instead of dividends. What do we mean by that? So a firm that has a large amount of cash remaining in the firm and wants to pay out that cash, doesn't have that need right now, so instead of paying it out in dividend, which are considered to be sticky, market is expecting that on an ongoing basis, instead of that, they go out and use that cash in buying back their own stock. Repurchases are not expected to be sticky. There is no expectation from the market to be for the firm to be able to do this on an ongoing basis. All right, the fourth factor is tax consideration. And again, this is really dealing with the taxes on capital gains versus taxes on dividends. You know, if there is systematic benefit to one source of cash flow, that is the cash flow that would be favored in the market. The fifth factor is the flotation cost. Flotation cost affects the cost of new equity. So when the flotation costs are very high, it makes sense for the firm to generate equity capital in the form of retained earnings. So rather than issuing new stock, it makes more sense to use retained earnings to generate equity. So when flotation costs are high, you tend to see dividend payment to be lower. The last factor is contractual/legal restrictions. So certain countries may have specific legal restrictions about companies that could pay out dividends. Certain bond covenants may specify conditions under which dividend payments can be made. So those are the contractual/legal restrictions. These are the factors that influence the decision about what a company's dividend policy should be. All right, so let's talk about the effective tax rate on dividends. We'll talk about the concept of double taxation, and then we'll talk about the split rate system. All right. So first, let's talk about double taxation. Double taxation, once again, you know, simple case, you see this as one of the big disadvantage of corporate form of business, and that is there is a tax assessed at the corporate level and tax assessed at the individual level. So the formula for computing the effective tax rate in the presence of double taxation is the corporate tax rate plus an additional tax, and that is 1 minus the corporate tax rate times the individual tax rate. That adds up to your effective taxation or effective tax rate. So if you want to memorize formulas, that's your formula. Let's look at it real quickly using an example. Makes things a little simpler. So we will first look at the earnings before tax for a corporation. It's $100. We're going to subtract tax at the corporate tax rate of 40%. And so we got net income of $60. Let's say that net income is exactly equal to the dividend. We have 100% payout just as to keep things simple. And then we're going to do taxes on that dividend at, let's say, individual tax rate of 30%. So we have $18 as the tax applicable there. We got $42 as the net amount remaining. So that is your after-tax cash flow. Okay, so we started out with $100. We ended up with $42. So the effective tax for the company as a whole is equal to 58%. So we started out with $100. At the end of the day, net amount remaining in the pockets of the investors is 42. The effective tax rate is 58%. Now I could use the formula. Remember, the formula says the tax rate for the corporation plus 1 minus tax rate for the corporation times the individual tax rate, which is 30%, and that adds up to the same 58%. So that is your double taxation. You are expected again to be able to compute the effective tax rate. All right. So coming back to the split rate systems, the formula for split rate is the same as the formula for double taxation. However, for the tax corporate, we're going to call it tax corporate for distributed income. So what happens in a split rate system, and these are regimes, there is none remaining. There used to be one many years ago, but it is no longer in place. So there is only historical significance to the split rate system. When that system was in place in Germany, the way it worked was there were two tax rates on corporations. there was a corporate tax rate for distributed income and a corporate tax rate for retained earnings. So the distributed income tax rate was generally lower. So under that system, the tax rate that the companies pay on the portion that they actually pay out in dividends was lower as compared to the portion that they retain. So in this formula, the tax rate that I'm going to use for corporation, the corporate tax rate is going to be for distributed income. Again, it is corporate tax rate, not individual, but corporate tax rate for distributed income. Use that. So for the exam, if you're given two corporate tax rate, the one for distributed income is the one that you're going to use in this formula. The last one is imputation system, the easiest one to follow, no special formula. The effective tax rate is the individual's tax rate, the shareholder's tax rate, nothing there. Okay, very simple. What happens is the shareholders are going to receive a tax credit for whatever the corporation paid. So whatever the corporation paid as a tax is simply more or less a deposit made in the name of the shareholder. So the shareholder owes a certain amount of taxes, and against that tax liability they can use the money that the corporation paid as an offset. So effectively the tax rate is simply the shareholder's own tax rate. One nice thing about imputation system is that it eliminates double taxation. So that is the most preferred method, but very, very, very uncommon. So there is no double taxation under the imputation system. All right. Now, what about the concept of stable dividend policy? Once again, earlier we talked about dividends are considered to be sticky. And because dividends are sticky, because investors really penalize companies that reduce dividends, companies seek to keep dividends to be stable. In fact, investors consider those companies that are having stable dividends as less risky and therefore assign a lower required rate of return. If you are using a lower discount rate or required rate of return to value stock, well, the value of the stock will be higher. So it makes sense for a company to pursue stable dividend policy. Okay? So how do you do this stable dividend policy? You base your dividend based on a long-term forecast. So you forecast out your earnings over a long period of time. You figure out how much you can afford to pay without disrupting the operations of the business and allocate that money smoothly over time. The second one is the constant dividend payout policy. Very, very rare to see this occur. And under a constant dividend payout policy, the dividend payment is actually allowed to fluctuate with earnings. So your payout is constant. The percentage of net income is constant. So if the company has payout of 50%, they'll pay out 50% of whatever their earnings are. See, the earnings fluctuate, so does the dividend. So one of the big problems with the constant dividend payout policy is, even though the name says constant, it really results in highly variable dividend payment. All right, let's talk about the residual dividend model. Okay, what is residual dividend model? Now, this is an important element, so make sure you're on top of this. And it is more or less a model very unlikely to be practically used by businesses. But nonetheless, let's talk about how it works. So dividends are simply an afterthought. They are residual. Okay, that is the basic fundamental philosophy of the residual dividend model. Dividends are an afterthought. So dividends are going to be earnings minus retained earnings. These retained earnings are not random. They are systematically linked to finance the equity portion of the capital budget. So if the firm decides that they need $50 million worth of equity to fund capital projects, that is the retained earnings they're going to keep, and then whatever the earnings turn out to be minus that $50 million will be the dividends. So once again, dividends are an afterthought. Now, residual dividend model is based on three elements. These are the inputs that go into it. The first one is the IOS. IOS simply gives you what? Your capital budget. So investment opportunities schedule gives you your capital budget. So what is the investment opportunity schedule? It looks at all the projects with their associated returns, associated NPV. We say these are the projects I want to take. So that's your investment opportunity schedule. That tells you how much money you need. Okay, that is the amount of capital that you need for next year, for example. The second element is the weight of debt and weight of equity, capital structure issue. What is your target capital structure? So how much of the capital budget are you going to finance using debt? How much are you going to finance with equity? The third element is access to and cost of external capital. So within equity, we recognize some portion is going to come from retained earnings, some proportion is going to come from new issue of equity, and the new issue of equity is going to be influenced by access to and cost of external capital. We will look at a simple case scenario where we are not going to rely on any external capital. So we'll look at a simple case scenario just for illustration. All right? So what are the steps to determine the target payout ratio? Identify the optimal capital budget. Let's suppose it is equal to $100 million, okay? Let's suppose the optimal capital budget is $100 million, okay? Now, determine the amount of equity that is needed given target capital structure. So supposing we are given the target debt to equity ratio is equal to 1. If target debt to equity ratio is equal to 1, that means the weight of debt or debt ratio is equal to 0.5 and weight of equity is equal to 0.5. Okay? So debt to equity ratio is equal to 1, and that translates into weight of debt is equal to 50%, and weight of equity is also 50%. How do I get that? Let me give you a formula. So debt ratio is the same as weight of debt, and this is debt ratio in your weighted average cost of capital formula. Okay? So debt ratio, or also known as debt to asset ratio, is equal to the debt to equity ratio divided by 1 plus debt to equity ratio. Okay, so in the example that we just looked over, we said debt to equity ratio was 1, and therefore the debt ratio is 50% or 0.5. All right? So coming back to our slide, identifying optimal capital budget. Again, we said $100 million was my optimal capital budget. We said 50% of that was coming from debt, 50% from equity. So I'm going to write down equity is equal to $50 million. Okay. Now, meet the equity requirements to the extent possible from retained earnings. Supposing suppose net income is equal to $80 million. Okay. In that case, retained earnings, I'm going to keep it $50 million, the entire amount of equity. And that is our, again, simplistic case scenario. We're not going to rely on any new capital. And therefore, dividend will be equal to net income minus retained earnings. And that turns out to be $30 million. And this is what we call as residual earnings. So the dividends of $30 million is not based on some conscious analysis of what the dividend should be. It is simply an afterthought. It is the residual. It is whatever was left over. So it is based on the firm's earnings and the firm's investment opportunities. So what are the advantages and disadvantages of using the residual dividend model? Advantages, it is very easy to use. We just went through an example, pretty simple to apply. Also, management can then focus on investment opportunities. That is the prime objective there, right? That is what the managers should be charged with, that they should be focusing all their energies into seeking out positive NPV projects. Dividends should be not their primary goal or primary focus. So those are the two advantages. Model is easy to use, and the managers can be focused on seeking out the most profitable investment opportunities. What are the disadvantages of using the residual dividend model? One of the big thing is dividends tend to be unstable. Remember, they are afterthought. They are not based on some stability analysis. So they are an afterthought. So as your earnings fluctuate, as your investment opportunities fluctuate, so does the dividends. So dividends tend to be very volatile. And this uncertainty in this dividend results in investors, results in the market assigning a high cost of capital for that company. Results in what? It results in lower stock value. So that is the big problem. And that is one of the reasons why you don't see application of residual dividend model in real world. Now, what are the other ways, other approaches? We recognize there is some strong fundamental benefit to using the residual dividend model. We recognize how residual dividend model really focuses on investment opportunities, which is what it should, which is what business should. So, can we find a middle ground? And that's what this approach is. We call it the longer-term residual dividend model. What we do is we are attracted to the advantages of residual dividend model, but we don't want the disadvantages. So what do? Instead of doing on an annual basis, we forecast our capital budget over a long period of time, let's say 5 to 10 years. We do the same thing for our earnings. We forecast our earnings over that 5 to 10 year window. And then we do the same thing but over a longer window. Okay, so let's say over the next 10 years, our capital budget is going to be, once again, $100 million. Our earnings over that same window will be, let's say, $120 million. And we want to do 50% debt, 50% equity. So 50% equity is $50 million. So over that 10-year window, retained earnings is $50 million. And therefore, dividends will be $70 million. And I can now divide that over a 10-year window and say, well, why not we smooth it? Every year we're going to pay out $7 million in dividends. So it becomes very stable, very much desired by the market. And so that kind of takes away the flaws or demerits of using the residual dividend model year over year. Now, other policy approach, most common one is the steady dollar dividend amount. So companies stick with the dollar amount, let's say 50 cents per share, and stick with it unless there is a wide divergence, meaning earnings are very high and they're expected to be very high, then it makes sense to increase it, or earnings are very low and expected to be very low, makes sense to decrease it. So steady dollar dividend policy, very commonly applied. All right, other approaches include target payout adjustment model. So assuming there is actually a specific level of dividend payout that is optimal for a specific company, then we want to balance the payout as a percentage of earnings, which makes the dividends very volatile, but we want to balance it with some stability. Then that is what the target payout adjustment model is. So target payout adjustment model balances constant payout, meaning as a percentages of earning, with stable dollar amount. Okay, there is a balance there. We'll look at the approach. We'll look at the formula, very important formula, in just a second. So what is the general approach? First one is to set the target. That is your constant dividend payout. Let's say you decide your constant dividend payout is 60%. That's the first component. And this is based on some fundamental analysis that maximizes the firm's value. Say, for example, there is an optimal level. We want to find that optimal level. For our purposes, that is beyond the scope of the curriculum. However, let's say that is 60%. So move slowly toward that target. Why slowly? Because stability. Okay? Because of the stability that we want. So move slowly towards that payout rate. So stability is very important so as to ensure that the market rewards us with lower cost of capital. And then finally, avoid cutting or eliminating dividend. Again, the same principle applies. When a firm cuts or reduces dividend, it is considered to be a very strong negative signal. Let's look at how the model works with an example. So here we have earnings of $3.50 per share. You're given the actual dividend last year was 70 cents per share. And then in the current year, the earnings actually go up to $4.50 per share. You're given that the target payout ratio is 35% and the adjustment period is 5 years. So what is this 5-year period? That gives you a smoothing component, and therefore you're going to smooth your payout by 1/5 during any given year. Okay, we'll see the application using the formula. So here is the formula. Expected dividend is equal to the previous dividend plus some adjustment factor. Notice the target payout adjustment model grounds the existing dividend to some base level, and that is your previous dividend. This gives you the stability. Now you have that base, a strong base, and then you allow certain fluctuation. You don't want the fluctuation to be very high, and that is why you're applying the adjustment factor. Remember, the adjustment factor in this example is 1/5. So you are absorbing the shock, or you're reducing the shock by 1/5, if you think of that way. All right. Now, the first element within that fluctuation factor, within the second component, is expected increase in earnings per share. In our example, we have $1 increase in EPS. The second factor is simply the target level. We say 35%. All right, so let's look at the data as given to us. Once again, last year's dividend was 70 cents, and then we go with 450, which is the new earnings minus 350 old earnings. So that is again $1 increase in earnings per share that we talked about. The target payout ratio given to us is 35%, and the adjustment factor is 1/5. So we are trying to smooth it out. All right. Now that means that next period's expected dividend should be 77 cents, assuming the firm follows a target payout adjustment model. So the change in dividend is only 7 cents, or 10% increase in dividend. So in this case, notice, even though the earnings actually grew by 28.6%, dividends were much more moderately growing at 10%. Why? That is the shock absorber in play. That is the stability that we are trying to achieve. So what about stock repurchases vis-a-vis dividend? Remember, companies can pay out cash in two ways. One is to pay out actual dividends. The second one is to buy back their own stock. Now we say that, in absent any tax advantage to one or the other, it really doesn't matter, right? So if the tax treatment for capital gains was exactly the same as dividend, it really doesn't make any difference. We are ignoring for the time being the fact that capital gains tax can be postponed. We are just keeping things simple for here. All right. Having said all of that, we still have certain specific rationales for stock repurchases. There are 5 of these in the curriculum, and we need to be on top of all 5. So let's understand what are the rationales that are acceptable under the curriculum for stock repurchases. First one, as we already talked about, the tax advantage. If capital gains tax is favored, then it makes more sense to use stock repurchase as a mechanism to pay back cash to the shareholders. Again, we talked about why capital gains may be favored, the tax rate may be lower, or the timing may be the timing ability may be critical. The second reason is signal to the shareholders. Now, if the management is thinking that the market is currently undervaluing their own stock, they can send out a strong signal to the market by buying back their own stock. So when that occurs, when the company announces a stock buyback, market receives that information, receives that signal in a very positive light. The market thinks, hey, they must think that the stock is undervalued. That's why they're buying it back. And so that helps them shore up or boost the value of the stock in the market. The third factor is added flexibility. Again, we talked about repurchases of stock are not considered to be sticky, and because of that, market is not expecting an ongoing, recurring stock buybacks. And so if there is a large amount of cash that the firm wants to quickly give out, they can use repurchase as an option rather than dividends. Another valid reason is offsetting dilution. When a company has employee stock ownership plan, that results in, if for example, if they're issuing options, that may result in dilution, meaning more number of shares outstanding in the market. Well, to offset that dilution, company may choose to buy back their own stock. Very common reason for buybacks. The last one is increased leverage. Let's suppose the firm has a target capital structure of 35% debt, 65% equity. Currently, it is using 20% debt and 80% equity. So he wants to quickly realign its capital structure to its optimal level, what it can do is to borrow tons of money and use the borrowed money to buy back its own stock. When they do that, it dramatically changes the leverage, dramatically changes the capital structure. So those are the 5 valid reasons, at least according to the curriculum, for stock buyback or repurchases. Now, as a generalization, one of the things that has occurred, and this is again kind of dated by now, but still this is what the curriculum says, and that is what have been the global trends in dividend policy. What have we seen? We see that in the US, a lower proportion of companies, at least over time, distinctly if you look at over time series, companies are paying less and less in dividends, okay, as compared to their European counterparts. Also, generally the portion of companies that are paying dividends is reducing, at least in the developed markets. In general, you know, US is much more stronger evidence, but still globally, at least in the developed markets, you see less and less cash dividends being paid out, maybe because of the tax negative element of taxation, less desirability of dividends, if you will. And then finally, instead of dividends, we are seeing more and more use of stock repurchases, at least again in the developed markets. So this could be, there are actually a variety of hypotheses, but we don't need to worry about it, why this is occurring. The only LOS talks about is you should know what is occurring, and this is what the reading talks about. Okay, so the last element is what we call as sustainability of dividends. As an analyst, you're trying to figure out if a company is going to be able to maintain its payout policy. So we call these dividend coverage ratios, but they are really sustainability of payout. Okay, this is an assessment of payout. And so we are looking at first two ratios are only looking at dividends. The last ratio is looking at not only dividends but also stock repurchases, stock buybacks. All right, so the first ratio is dividend payout ratio. This is the common ratio that we have seen all over the place. We have seen it at level 1, and that's your dividend divided by net income, dividend payout ratio. Remember, retention ratio in your sustainable growth rate formula, retention ratio D is 1 minus dividend payout ratio. So, okay, so that's your dividend payout ratio. The next ratio is dividend coverage ratio, just flipping the payout ratio, so it's inverse. So dividend coverage ratio is net income divided by dividend. Generally speaking, the higher the coverage, the higher the sustainability. So you are looking for dividend coverage ratio to be high, more sustainable if the ratio is high. Just like interest coverage ratio, same logic. Okay, now FCFE coverage. This is something new that you would not have seen elsewhere, and that is the free cash flow that the firm has after meeting its obligations. So FCFE is the earnings that the firm has after meeting its working capital investment requirements, its fixed capital investment requirements, its obligation to debt investors, to the bond investors, for example. After all of that is taken into account, these are the free cash flow that is available to be paid out to the equity investors. So we call it FCFE. We have a lot of coverage of free cash flows in equity valuation portion of the curriculum, so you'll see a lot of that at that time. But for the purpose of this reading, FCFE is free cash flow to equity. We divide that by dividends plus stock repurchases. Once again, higher the ratio, higher the sustainability. As an analyst, you look at the ratio over time, and if the ratio is increasing, if the coverage ratio is increasing, then you say, okay, my comfort level in the sustainability of dividends is high. All right, so that concludes the relatively shorter reading on dividend policy. So we talked about dividend theories. What are the factors that influence dividend payout policy? We talked about those 6 factors. We also talked about the residual dividend policy. We talked about residual dividend model, where dividends are an afterthought and important in terms of exam, even though in practice very seldom used. In fact, you know, we talked about how we can have the advantage of this nice policy or nice theory by using longer-term residual dividend policy. Then we talked about stock buybacks. Specifically, we talked about 5 valid reasons for stock buybacks or stock repurchases. And then another big element is the sustainability. This is an analyst approach, and we are trying to assess the relevant sustainability of dividends or payout as applicable. So that is the dividend policy reading. Keep on chugging along, do some practice examples, and it should be on. You should be having less of a trouble with this reading at least. All right, see you around.